Testing. Okay, we good. Um, hey, ladies and gentlemen, welcome to the FOMC live stream. We'll be going through the FOMC live stream with Powell speaking, but we will start from the trades that I'm holding and what I'm anticipating with Powell speaking. So the first thing that I'll look at, I have a trade on gold. Gold is holding strong support. I mean, gold broke above the $3,000 $3,000 per ounce. So if you wanna see that, you can just easily go to you can just easily go to sorry about that. Let me just quickly do this. You can just easily go to the previous videos where I shared or join our Telegram on the bio. So I'm thinking gold might hold this high and continue to the upside. So that's my anticipation on gold. Um, That's my anticipation on gold. Sorry about that. I'm just a bit distracted. That's my anticipation on gold. And for the dollar index, so I feel the dollar index will hold this gap here. Oh, come on. The dollar index will hold this support, this resistance there, and continue lower. And the reason why I am saying this, and I'm so adamant about saying this, and I'm sure about what I'm saying right now, it's because I'll just quickly take you through the fundamentals and what I think based on the fundamentals. So, so when you look at the FOMC today, the Fed's interest rates it's at 4.5%. Sorry, the Fed's interest rate is at 4.5%. I think they'll still keep it 4.5 for now, given that CPI did drop, PPI did drop. I don't think they'll rush into decreasing interest rate. I think they'll keep it at 4.5 until they start to see that the inflation story it's now at least it's controlled. So if I were to look at the Excel spreadsheet where I have all the documentation. So we start with interest rate. So this is interest rate. In the US, interest rate is at 4.1%. And at 4.1%, you see that there was a slight increase in interest rates while while NFP came down lower. So there was a slight decrease in the jobs opening, and the NFP numbers can slightly indicate that if we to see interest rate and unemployment claims, you would clearly see that there was a slight decrease in unemployment. Um, quickly, and then, oh, come on, technical issues. I hate these technical issues. I don't know a lie. But anyway, I hate technical issues when I'm streaming. Ooh, shucks. Okay. Anyway, unemployment rate, I mean NFP, Feb NFP was at 151. And they forecasted 159. So there was a slow drop in NFP numbers, while retail sales in Feb, we saw retail sales came out low at minus 0.9, and this month came out as 0.2. But the minus 0.9 indicates a slow in the US economy, which was good for saving. This was good, according to me, this was good for saving the US stock market because, yeah, a lot happened with the US stock market. And looking at this numbers here, we saw that the average here is zero point 0.4. The average growth of retail sales in the US it's at 0 0.4, while last month we got a zero point 0.9 minus zero point 0.9, which indicated a slow in the economy. Now we saw a slight growth of 0.2%, with CPI came out at a whipping 2.8. So if you look at unemployment rate, NFP retail sales from last month, this will clearly show that um, the the remember CPI, the target of the Fed is to get CPI at 2%. So now is to get CPI at 2%. Hold on for me. Just quickly answer here. Sorry. Is to get CPI at 2%. Sorry about that. I'm just quickly fixing some technical issues here. Okay, let me just quickly finish this, then I'll attend that. So, as I was saying, sorry, um, CPI target. So the Feds are targeting 2%. So with retail sales, CPI and inflation coming out cooler, that indicated a slow in US economy. And then that CPI was an indication of that because CPI came at 2.8, which was good to save the stock market. And the stock market now is starting to rally up because with Trump's tariffs, um, we saw this rally here. How many percent was this rally, by the way? So this was the dollar came down by 6.4% within 74 days. But if we're to look at NASDAQ and S&P 500 on the other side, they got the biggest hitting here. Term tariffs, inflation being high, within 49 days, NASDAQ was down a whopping 14%. So bring NASDAQ with down 14%. Then CPI came in and saved the day. I believe CPI or inflation saved the day in the US because now we're holding the support because CPI started to indicate a slowing down of an economy, which could in turn today it's a huge day where the Feds might not cut or might not increase interest rate. Because remember, if just quickly do this, if inflation, let me say this is inflation. If inflation goes up, if inflation goes up, if inflation goes up, the Feds have to increase interest rate. Reason being, it's trying to control the stimulate, trying to control the overgrowth of the economy. Because if the growth is not controlled and is not healthy, eventually it will reach a plateau. So remember, if something like this happen, eventually it will reach a plateau and it sinks down. So that's what they're avoiding. They're avoiding the scenario. That is why once in a while they will when interest rate goes up, they'll increase interest rates. But in this case, we saw the interest rates coming down. So what do the Feds have to do? The Feds they either keep interest rate the same or they decrease it. And this is good for the stock market. This is very good for the stock market because now it becomes cheaper for companies to borrow money to put into their company to open more branches in a layman's term and to fund their company. It's easy to borrow money. However, if if um, if now interest rates continue, I mean, inflation continues going up, interest rates goes up as well, it becomes too expensive. I don't think if that was gonna hold. But so the slowdown of the economy did do good to the stock market in the US. So That is why I'm saying inflation was a good story in this instance. So yeah, for the trades that I'm holding gold, holding supply there. So hold my stop loss is just below this low. I am gonna wait for a retracement. Oh, come on. I am gonna wait for a retracement there to continue taking gold higher. I might enter another trade. Uh, I might enter another trade for gold because the 3,000 mark, it seems like a very strong support within using the 4-hour time frame. So whatever happens today, if we get the Fed's cutting interest rate, this is good for gold. And the reason why a lower interest rate or keeping the interest rate the same, which after that Powell will have a positive outlook during the meeting, then that it means gold might push down and continue to push up again because a lower interest rate, it's not good for the dollar, and the gold and the dollar correlation now comes into play because lower interest rate, now people are not interested in buying the dollar as a form of it's not easy to borrow money to the dollar because now you get in return, you get the interest in return is not as high. But if interest rate is high, your returns are good. I don't know if it makes sense. Higher interest rates, higher returns if you are borrowing, if you are lending out money. Lower interest rate, lower returns if you are lending out money. So in this case, if the dollar, which is the US, lowers interest rates, so for you to lend money to the using the dollar, lend money to the US government, now your return from your lending money, it's extremely low. So people move into other currencies. Your pound, but pound is also slightly higher, your British pound and others. But in this case, because the pair, if we were to look at gold pair, um, it's XAU USD. So therefore, it might favor gold and US stocks in this instance because people, there's so much money people that are holding. The economy has been just kept. Now people are willing to buy more stocks. People are willing into spending. Hence PPI. I think I'll have to add PPI on my spreadsheet. But I know PPI will come out slightly. PPI will start, which is a producer price index and consumer price index. You start to see now that increasing as well because people are spending more money into the market. Okay. What was interesting for me today that I think I need to go through it before the big man speaks. It's the BOJ policy rate. I anticipated that maybe this month we might see them taking the interest rate to 0.75, but that didn't happen. So I was going to look into selling or buying more. I'm going to look into becoming bullish for the Japanese yen. However, in this case, I kept it the same. I do not like, I don't like it anymore, honestly. And to show you that here, look at CHFJPY. It totally reversed. We got short, we got long here below this low. We went long, we went short after it held this support here. And then we took stop losses just here and then now it has totally reversed. We are holding this fair value gap. Oh shucks, I'm not even showing you what I'm going to show you. Anyway, I was saying we went short on this low, went lower. So we went short what time is it? Okay, we have 10 minutes. We went short at this high. We went lower. We put stop loss there. We got triggered. So now it just totally reversed, leaving this fair value gap that will be my interest or this support that I'm looking for a retracement to the upside. So that's what I'm looking for because it seems like since they didn't cut interest rate, sorry, if they didn't cut interest rate, if they didn't increase interest rate, which is the BOJ, I do not favor that currency as a form of investment. So I rather go into the other pairs. We also saw USD JPY now giving us a full reversal now. but now it's still holding this support here. It's still holding that support. So let's see what's going to happen. I think the big moves will come after the interest rate announcement. So the interest rate announcement will give us an idea where we're going. Um, but and yeah, so I think that's all, guys. I went for a rant, and let's go to the day trading, the second segment of the show, which is day trading. Looking at what's going to happen with the FOMC today. So if the FOMC, if they decrease interest rate today, I will watch USD CHF very close because we might see something a break. Ah, come on, a breakout here and a retest to continue lower. So yeah, that's what I'm waiting for. Okay, I think I've explained enough, mumbled enough. I do not have any other trade. Another pair that I like is GPB USD. So GPB USD is a pair that I extremely like. The fundamental spreadsheet that I have is bullish for GU, GPB AUD, GPB NZD. It was bearish for USD JPY, but with today BOJ data, I'll just be closely watching. I have to update it. We might start to see anything against the yen being neutral. So in this case, I'm waiting for a retracement to this low to continue higher. That's what I'm waiting for GPB USD. That's what I'm waiting for. And GPP AUD, I had a trade. I did explain. Please watch the previous videos to see what I was looking for. And it looks like my longs is coming out. Okay. Oh, shucks. I missed it. No, I didn't. I did. Oh, God. Okay. I was looking for a trade here. I think I missed it. I was looking for a trade at that support. Because we held this support. We held this fair value gap here. We had this 4 hour fair value gap. Um, and now we are holding this. So I was looking for longs here. I might decide to put in my limit depending on what the market does here and then to look for longs because I still love GPB, AUD, GPB, NZD as well. Let's see if this friend is lagging here. I did explain about this trade. Just quickly go watch the previous videos. Okay. Okay, no. I think I'm gonna go long. I prefer now. I'm favoring GPP NZD. I'm gonna go long on GPP NZD. I'll try the longs on the retest here again. If it does give me the retest, just yeah, I'm gonna look for longs on GPP NZD. Still bullish, so why not? Yep, I'm gonna look for longs here. Come on, okay. Let's get ready for FOMC, guys. I need to get ready for FOMC. So this is what I'm gonna look for. But anyway, let's get ready for FOMC and we watch what the market direction of the market. And before we do that, okay, I'm just gonna quickly do our day. The second segment. I'm just running around today. Hmm. Okay, let's do this, guys. I'm gonna continue analyzing here. Da, 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 da. Okay. Let me quickly do a setup of the FOMC here. Choo- So, guys, tell me, where can I watch FOMC anyway? Okay. Okay. Let me just quickly. Oh, speech. Ta-dum. Is Trump speaking? All right. We are set for FOMC. Oh, flip. I opened the wrong. Okay. Let me just quickly take this. Quickly take this. We'll be set now for FOMC. I'm just quickly. I have 3 minutes to set up for Power Speaks. Dun, 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 dun. So today I'm a bit dear Makar, guys. You have to pardon me. What the hell? Today I'm a bit dear Makar, guys. Please pardon me. No, can be. Okay, anyway. Uh, okay, it looks like, yeah, we are set. Let's see. Okay. I'm setting up, guys. Let's go. Oh, come on, man. Was I not gonna set up this off screen? No, you're not. Okay, okay. We are set, guys. They are about to announce the interest rate decisions. So let's look at the reaction on the market and then we'll look at the numbers. So while waiting for the reaction on the market, throughout 6 or 8 o'clock, they will announce the interest rate decisions. I am looking for this low to come to during the PM session now. And oh, let's see. Ooh, it bought and sold. It bought and sold. It sold and bought. Okay. Wow. Okay. Interesting. Let's see the numbers. Let's see the numbers, then we can interpret the numbers, what we're looking at. And let's see the numbers. That was a good buy decision. I think it's either they kept the interest rate the same or they decreased the interest rate. That's what I'm gonna say. Kept interest rate the same or they decreased interest rate. Uh, okay, let's see the number. Yeah, they kept the interest rate the same. And what does it mean? This is a bit bullish for indices. That is why we saw the good move to the upside, even though the market did already price um, the decisions already. However, given that it remains zero point 0.4 and that could save the day for for the stock market. Okay, that will save the date for the stock market. So I do love the decisions. I think we will start to see NASDAQ pulling to the upside. We will start to see NASDAQ pulling to the upside. Um, so let's see what happens now. Powell will start to speak in a few. Here we go. Powell will be speaking now. Let's see, but for my NASDAQ trade, we swept this low and push to the upside. Let's see what's gonna happen. We were holding this 15 minutes value gap here. 15 minutes low. Let's see. Lunch hour low. Okay, AM low. This is an AM low. So this way the market opened. We pushed to the upside. Now it's ranging. Okay, we swept. Oh, interesting. This is something that I don't want to see. Um, US30, yeah, it gave good moves. US30 during the announcement of the interest rates, it is the one that gave good moves. So we just swept yesterday's high. Just quickly mark that. We could retrace back, honestly. I feel like we could retrace back. Oh God, today I was a dear Makara. Couldn't even prepare my chatting early. Okay. So here we are 4 hours we are holding this fair value gap to the upside. Just gonna mark that. Okay, let's go through the FOMC. Let's see if it's up. It's ready now. Oh, the big boss is not here. The big boss is not here. So the big boss has not started talking yet. I'll just do my ranting with my D Amakar being short everything. Okay. Uh, we are holding this support here, and it's also holding this 15 minutes fair value gap. I'll also mark this 15 minutes fair value gap here. So it is holding the 15 minutes fair value gap, and AM, we just swept the AM low. So I think my game plan here, just remove this friend, yeah, just put it right. Here we go. So my game plan here for tonight during FOMC, if we see a candle closure above this 15 minutes fair value gap, I will look to buy. I won't look to buy. However, if it flips this candle now and we come back lower like this and close this 15 minutes bearish, I might look to sell again. But now it all depends on what the big boss will say tonight, you know? It's not up to me, it's not up to anyone. I think this is more bearish than anything. I think I am more bearish than anything, given what S&P 500 is doing. Yeah, I think I'm bearish. But now, whatever happens next, it's up to the big boss power. Okay, I am low. Okay. Does it give a trade? Let's see. Let's hear what Powell is saying, guys. Okay. Yeah, I'm gonna wait. Is a big man up? Not yet speaking. Wow, this guy's taking forever to speak. Oh, I'm watching a wrong thing here. This guy's taking his time. Let me see, yeah. Uh, oh God, I'm tired. Oh, thanks. Okay. He has not started speaking. Okay. He has not started speaking. So my first target will be the AM low. I think I am gonna target the AM low for now. Until he starts speaking, I am gonna target the AM low. Sorry guys, I'm just gonna be responding to a certain text. Okay, let's see. Anyway, while waiting for Paul to speak, this guy doesn't wanna speak, eh? He doesn't wanna speak. But anyway, let's go to what happens now since the interest rates. It's they kept the interest rate the same. So keeping the interest rate the same, I personally believe they're trying to be cautious. They're not trying to say we'll increase interest rate and that pushes inflation higher again. So what they're doing, he's trying to be more cautious. What's gonna happen now? It will save Nasdaq. I believe Nasdaq and S&P 500 we will start to see a move to the upside like that. And that's a move that I'm waiting for. And I'll go long only if the my fundamental bias spreadsheet is already updated and it has given me a good bullish reading. While on the other side, gold, I think gold is still gonna push to the upside. Kept interest rate the same, it's trying to be a bit cautious. However, it might give us a pullback and pull up to the upside because now there's not so much inflation is lower, interest rate is kept the same. So the economy is still gonna still be pumped back. The economy is still gonna do well in the coming few months. I mean, in the coming month or two, until next meeting to decide on the next move on the next meeting. But with this meeting, I think for me, I'm happy with the meeting with the interest rate that is not cut. I think I'm happy with that. I think that's what keeps me happy now. Because now, if they went on to cut interest rate now, we were likely gonna see a reversal in inflation. What do I mean? Just quickly show you this. Uh, this guy has not started speaking. So we were gonna see this. Now, if we're to look at the inflation, yeah, we started from last year, we were very high during COVID. We came all the way down to about 2.5, 2.4%. Now we're starting to see an increase in inflation. We started seeing an increase in inflation. What is at 3%? We started being now like as the inflation gonna push higher, it's gonna create problems. People will start now being expensive. People home loans will start being expensive. Loans that people have taken will be expensive now. The economy has to slow down. With increased inflation that we saw, there was a slowdown in the economy. We saw a 0.9% in retail sale, employment rate increased. We saw NFP numbers came out as 159. The employment data was a bit shaky, but that was not just shaky, but it was just an indication that the inflation is being kept. Inflation, the U.S. economy, it's slowing down. After we saw a direct slowdown in the U.S. economy, Now inflation came back 2.8. 2.8 inflation that could say to the Feds, we have gotten the story of we have gotten the inflation story under control. Let's not rush to decrease interest rate. Let's just keep it the same and watch where the inflation is gonna go, where inflation is gonna go. If inflation starts going up, at least they didn't cut too early. So basically, what I'm trying to say, I'm mumbling, I know, but what they're trying to say is what them not increasing interest rate or cutting interest rate. Basically, they're saying let's just be careful. Let's watch what happens after we've kept the interest rate the same. Are we going to start to see inflation going up? If inflation goes up, then at least they didn't rush to cut interest rates. So in this case, we are good. We are good for a retest to the upside. For NASDAQ, I think it's setting up very well to start pushing to the upside. So that's what it means to me. Um, and that could be extremely good for, by the way, for the Johannesburg Stock Exchange. This will be very good for the Johannesburg Stock Exchange. I do have a trade on the Johannesburg Stock Exchange. I'm holding Capitec. I am holding, yo, I'm mumbling a lot. I'm holding Capitec. I am holding Capitec. Here we go. I am holding Capitec. Yeah. So yeah, it's a good trade. I love the trade. I am holding Capitec Bank, which on the 23rd next week we have. So we are up about 4%. Wow, we are up 4%. I was thinking about, yeah, we're up 4% so far. Yes, we're up 4% on Capitec. In a way, one thing I've noticed is whatever happens in the USA tends to affect us in South Africa. So the fact that USA didn't cut interest rate or didn't increase interest rate, it's likely good to us because the Reserve Bank, I don't think, will cut interest rate. So, but I'm gonna hold Capitec, and I'm hoping that what do you call this? I'm hoping that my English is gone. The earnings will come out positive for will come out positive for Capitec, and then we'll push Capitec to break above and hold to continue to the upside. But that was Capitec anyway, where the Johannesburg Stock Exchange, the top 40 index, we broke above. I don't know if I took. No, I took an ETF that is monitoring Johannesburg Stock Exchange at this high. Yeah, yep. I remember I took the at this high. Yeah, I'm holding the JSE Top 40. Remember, I was on this trade until this high. I was taken out there, and now I am out here. But anyway, if you want to see all the trade ideas that I share and my ideas on the fundamentals and what I'm looking at, in the link below on the bio, you will find a link for the Telegram. You can join the Telegram. But anyway, let's get into it. I've been mumbling. Maybe the Powell is speaking now. This guy is still not speaking. Wow, interesting. Interesting. Okay, let me see my day trading. Okay, this is what I was waiting for, guys. I think I'm gonna go long. I am gonna look for a long position. We have stepped this 5 minutes value gap. We traded above, and the 15 minutes just closed above now. We just got an invasion of this 15 minutes fair value gap. Um, let me see if there's any SMT that was formed here. Yeah, there is an SMT here. There is an SMT between NASDAQ and S&P 500. I mean, and US30, sorry. There is this SMT that has formed there. Push to the upside. As I said, it goes, you can go back and watch this video. I did say on the start of this live that if the US keep the interest rate the same, it's good for NASDAQ. Look at this. And I'm just quickly looking towards what's gonna this guy will start speaking late. Oh god, I should have taken that trade. Just gonna look where this guy is speaking. Okay. I think they are prepared for the man. Come on. There's no sound. Okay. I will share the live once he starts speaking. They are getting ready for him. I'll show you now once he starts speaking. But anyway, let's see what's gonna have here. Oh, come on. Yeah. You know, this is me. Every single time I trade news, more especially when I day trade when there's news day, I'm a bit I can't say I'm scared, but I'm so careful that I do not want to just take trades, you know. Because here we have a fair value, the 50 minutes fair value gap that is holding, yeah. No, I'm gonna buy. I'm gonna buy. I'm bullish today. Just quickly tell me your bias, guys. What's your bias? Another 15 minutes fair value gap. What's your bias for tonight? But remember, a lot of things will be confirmed by what Powell say. But what's your bias for now? Yeah, this thing's not gonna come back. There is a fair value gap. Yeah, I think I'm gonna take it here. Should I take it here? Stop loss below. Let me see something. Just gonna watch that on a very better. 50 minutes fair value gap. So Nasdaq, we see an invasion of the 15 minutes fair value gap above on the 3 minutes time frame, for which I love the 3 minutes time frame. It has left this fair value gap here below the 15 minutes after it has closed above this fair value 15 minutes fair value gap. If we're to look at here, we got the invasion of the fair value gap. Let me mark it properly. So here we go. We saw invasion there. Let me just quickly close this. Yeah, we saw invasion of this 15 minutes fair value gap. Uh, and the only next fair value gap I have is this 3 minutes fair value gap here. I'm contemplating to take a trade. I might take a trade, but Powell might be a problem for me. I'm looking for something like this. Yeah, it makes sense. It makes sense. So we saw also, here we go. Look at this 3 minutes FPG. 3 FPG. So 3 minutes FF value gap it's holding. It's yeah, the market just weak below that. And it shows just slightly. We see another invasion. So I am gonna wait out until I decide what I want to do. Um, I, let's see. Uh, I am gonna take this one. Let me see. Is did he start talking? No. Ah, come on, man. Start talking. Okay, Powell has not started talking. Uh, yeah, has not started talking. I am gonna take this one just before he speaks. Did I? Fuck. I am taking this one just before Powell speaks. I am gonna be brief here. Ooh, I'm in. That was quick. Oh, shucks. I entered a wrong lot number. What did I do? I entered the wrong lot number. Oh, shucks. What was I doing? I said once. Yes. There we go. Uh, no, I entered the wrong lot number. If it goes low, I might enter another position. Uh, I'm in this trade though. So if we trade above this high, I am gonna move to break even. I don't like that the fact that I entered a wrong lot size. If we trade above this high and close above this high, I'm gonna move to break even. Did this thing enter me? Let me just add another position. Let's see. Just want to add another one if it retraces back because I entered the wrong lot size. Yeah, but anyway, okay. It's gonna enter two positions. If it retraces back, it will enter me on on the second position. Oh, come on, Paul. Come on. The guy has not started speaking. Just before he speaks, I'll go long. Come on. I think now the markets are just waiting for Powell to say something and to give them an indication as to where they are going. Okay. Yeah. So I don't know. The support is holding. The resistance is holding. I'm hoping this fair value gap holds and it just breaks above the current resistance where it is. And I think we good to go to the upside. But once Powell comes in, it's a total different story. It might be a total because I wanted to enter before he starts saying a lot, just to be on break even before he starts saying a lot. Because given what he says, but for me, I think he'll be more bullish than anything in his comments because CPI is low. CPI it's a bit 2.8, and he's not gonna try become a hero and tell them where what he's anticipating, but what he's gonna do is gonna say, we will be watching the inflation story as he always does. He will say, I'm watching the inflation story and see what happens with inflation. If we see inflation coming out still lower, coming back to 2.7, 2.5, he will say they will start cutting interest rate. The cutting it's not out of it's not out of the hook. I think that's what he's gonna be more. He'll be relying more on to being bullish than being bearish. But and they'll ask him about Trump as always, and he's gonna say politics doesn't define what the Fed does, but the market and inflation determines where they're where they're lying. Or so yeah, that's what I think. Anyway, that's what I think. Anyway, what's happening with this guy? Let's see. Okay, let's see. I think he's coming up. I heard a bit of sound. Oh no, he's not. He is not. Just get this one. Just like excellent coffee. So there is an SMT here already. So oh flip. Okay, my stop loss is uh okay. I'm triggered on the next position. So I have two position in now. And for one, I think they are preparing for him to come. I have two position on. Let's see. I will go between the trade and what the feds are saying. Okay. What time is he supposed to come in? Anyway. So you guys bullish or bearish? Let me know. Do you think Trump for tonight would be Okish or Davish? Okay, is yeah. Oh, come on, dude. Oh shucks, I didn't see this. I need to cut this off. I don't know if they'll do this because of uh, but, let's see. Okay, it's preparing. I'm just waiting for the lives to start.
My
Okay.
colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Okay.
Our
Nothing is
economy is
happening
strong
on this one.
and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal.
Okay, as I said, he's
This is
speaking
very
about that.
important. In support of our goals, today the Federal Open Market Committee decided to leave our policy.
Secondly, I had less than 10,000.
We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments.
Okay, I'll take you through Powell now.
Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1%.
Okay, I'm gonna move my stop loss to break even. Just quickly show you, I am gonna move my stop loss to break even. Look at what Powell did. We're just gonna close. I think we're gonna close above there. Yeah, I'm gonna move my stop loss to break even. Yep, stop loss are at break even. Okay, let's continue with Powell.
GDP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations.
Okay, tariffs, it seems like they're a bit of a problem as a major factor in consumer price increasing. It's not really inflation, but it's a tariffs of Trump in other countries, and the countries fighting back to put more tariffs on them.
2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions, we're leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last.
Introducing GoDaddy Email and Microsoft 365. Show customers that you mean business with a...
Damn it, these are just
Maximum employment and
annoying.
prices.
This is annoying. Sometimes.
Inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions
Here we
affect
go.
communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Okay, let's wait for the questions.
Howard Schneider with Reuters. Thanks for your time. So, two things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also frankly a little bit of inertia. When it comes to changing something in this highly uncertain environment, I think there is a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys, but if you look out 5 years or the 5 year forward, you'll see that break-evens are either flat or actually slightly down in the case of a longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture.
So tariffs are a problem.
Both household and businesses show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms. Can you say that today, that we have that price stability, that households and businesses are ignoring price growth when you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation?
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that
He seemed quite bullish, I should say.
Delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27. Of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
So basic trends with the tariffs are slowing down the progress of taking inflation to close to 2%.
2 cuts the last time, and they look at they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there. but core inflation up by 0.3. And so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low.
Yeah, on the trade, I am 80 ticks up. I am 80 ticks up. I don't know why it doesn't want to show, but it's showing on my phone. I think it's gonna go to a take profit.
It's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area. But at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with it's either noise, and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Sorry about that. I was just quickly setting up something.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last
pandemic? Yes, during the
because
pandemic.
you could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that, and it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design you are lowering economic activity and employment, And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability.
So this is what I'm holding. I'm hoping that it continue pushing to the upside and take me out. He sounds very bullish. He sounds very bullish for. He sounds very bullish. That there might be lower inflations, which will be in turn good for stocks and lower interest rates. So he sounds very bullish. That's why I've moved my stop loss just slightly above. Just that slightly above there. I'm about 101 ticks up. Just waiting slower. We're waiting for the full take profit. So I'm just gonna be waiting closely and watching it. So yeah, still as much as it still sounds bullish, I'm still gonna hold this until take profit.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this: we don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
So there is possibility of recession, but I don't think it will come.
Hi, thank you,
It's
Chris.
1:4 or so.
As you know, I guess last night President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I no desire to change that answer, and have nothing new for you on that today.
Well, well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
I've just moved my stop loss just to profit, yeah. I think it's a 1:2, almost a 1:1. I think I'm gonna move it to 1:1 just to save a bit of profit, because anything can happen, hence speaking. So I want this fair value gap to hold here with this 1 minute fair value gap to hold, and then I'm gonna hold till take profit if it goes to take profit. Yeah. So this is what I'm holding now. I know it sounds a bit sketchy, And the reason why I'm holding is because power still sounds very bullish, still hopeful for that there won't be the 1 is to 4 of recession. They are highly unlikely to have recession. Basically, that's what I was saying. Also, that there could be possibility of inflation coming lower, but the problem is tariffs. So much uncertainties in the market, not certain, and the contribution of higher inflation as well. It could be Trump's tariffs. So with Trump's tariffs being there, it's slowing down. It delays them in lowering inflation. In other words, so inflation basically, term tariffs are inflationary. So we are close to take profit, but yeah, let's listen.
We're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully. And we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know in a couple of months. We'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs, and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what in your mind would make something cross?
Check profit was hit. I'm out on the trade.
It would depend on what
I think I've taken a 1:2.2.
Direct evidence that
perfect trade, I should say. Perfect trade.
Inflation are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which by the way has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So
Interesting question.
Yeah, I mean, remember we came into this with, at the December meeting, the median was 2 cuts. The median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify. You were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah. So in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June? Whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's gonna be slower for longer, and people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and by the way, we still think that reserves are abundant. although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. Now, of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the...
So I think from what he just said that looking at both inflation and tariffs, so tariffs are contributing to the inflation idea. However, he still anticipates 2 rate cuts for the year because the unemployment rate, meaning the jobs data, it's constant. It's just moving around. It's either constant. It's just about 4.1%. It's not big of a problem. Jobs data is not big of a problem, but the problem is tariffs, and that it's slowly affecting the rate cuts. So I want to say maybe if there was no rate cut, if there was no tariffs, possible could have 3, 4 rate cuts for the year. But now because of tariffs, they're already projecting 2 rate cuts. And if there's more tariff coming in, the projection might go lower to one rate cuts, given that that will be inflationary as well.
Anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Here's a quick QT question. Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff though, because we want to stop runoff in net at some point. We haven't made any decisions about that. We want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in constant at some point, a point that we're not out yet.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy. And that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard. And in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move. As I mentioned, I think we're well positioned to wait for further clarity and not in any hurry.
I think I spoke about this when before the post started speaking, before the announcement of the rate. I said they won't rush to cut rates just so that they watch what happens with tariffs. How will they affect inflation? Because if they cut rate fast and there's tariffs as well, that might shoot inflation back to 3 or 4 above 3%. So that's basically what I was trying to say now.
Useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember. But we're past that. Beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market, the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macroeconomy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So We now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the twos, with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be.
I am for saying that the inflation, lower inflation, I think, has helped the stock market to hold support where it is. Now we kept the interest rate the same, so could look to for the stock market and we could look to the end of the correction. We might start to see being bullish now.
Hi, Chair Powell. Daniel Avis from Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens? It will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean. Hi, Chair Powell. Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. Slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was actually the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why pretty strong support. I'd just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
Okay. Okay, I've come to the end of our Powell speaking. We have only taken one trade, which went to our take profit. And this was because I did say that if we get interest rate that stay exactly the same, if we get interest rate that stays exactly the same, in this case, the interest rate stays exactly the same at 4.5, that could be bullish. That could be bullish for that could be bullish for the dollar. I mean, that could be bullish for indices, gold, and basically that will move more into risk on asset because they kept the interest rate the same. And for me, it's an idea of saying they're trying to be saying, let's be more careful because there's Trump's tariffs. So tariffs in general are inflationary. So they're just trying to be safe to just watch for the next two CPIs or to the next two inflation report where the inflation is going. They don't want to really cut interest rate quickly that could really take the progress away. So basically, that's what he was saying in general. That yes, there is possibility for two rate cuts this year. However, it's all gonna depend on the tariffs. If the tariffs will be inflationary and will affect how will it affect the inflation. So oh God, I'm tired. So I think that was it in general, but it comes back to the conclusion that we made or that I said before the lives before he started talking that if we get lower, in fact, I didn't think we're gonna get rate cuts. I thought we're gonna keep it the same to be safe so that when we move forward, um, we kept it the same and we're just trying to be safe to see what's the next move for inflation I'm tired now in relation to tariffs. So that's what we're saying. So I am starting with this with lower inflation, um, interest rate being kept the same. I'm starting to be more bullish on risk on asset. So I will be looking into buying NASDAQ very soon. Just me remove my day trading chart. Yeah. Uh, okay, but no, I could be moving. I'll start to moving into NASDAQ very soon. Oh, sorry guys, I'm a bit tired. Oh God, I'll start to move into NASDAQ very soon. We are holding this support. I might look to for the break above and continue to the upside. So once the spreadsheet that I use gives me a bullish reading, I might look to start to enter. I might look to start to enter NASDAQ or S&P 500. Yeah, that's it. So in general, basically, we are moving into risk on asset. That's my prediction. We are moving into risk on asset. So what I'm anticipating, I just want to see a clean breakout and a retest. I might look to go long only if the fundamental spreadsheet have updated and start giving me a bullish reading. And in this case, I'm more bullish than anything, to be honest. I just wanted to see this waiting. So I am gonna mark. So we see an invasion of this for our fair value gap here. And then there is another fair value gap that is holding at this low here. So I just want to see the reaction for the next two four candles. If the next one opens without coming and leave this fair value gap and opens and closes above, I might use it as my entry point for something like that. Only if the fundamentals make sense. Remember, only if the spreadsheet is updated to become bullish because I do not only look at interest rate, I look at interest rate, CPI, PPI, seasonality, trends. So there's a lot of things that I look at that really updates me. But really, I am bullish than anything because look at this support holding very strong. So if it comes back, I might enter it. We'll see. Um, so yeah, very good move. Very, very good move by, and he sounded very, very bullish for than anything else. Sounded positive that we will get rate cuts this year, and that favors risk on asset because in general, when the interest rate is low, borrowing it becomes cheaper than people are willing to spend. Ooh, sorry guys. Oh God, I'm tired now. I think this is the end of us. See you next week, guys. Since in South Africa, Friday it's a holiday, I am not gonna be live tomorrow and Friday. I will be traveling to see my beautiful woman. So I won't be need to see my wife and kids, guys. So I won't be around. I won't be around. But one thing I should say, I love that USD is holding. But anyway, I'll never stop ranting. So this comes to the end of our session, guys. Thank you so much for joining me. If you want to join the Telegram group, do not be scared just to go through to the link. Click the link in the bio where there's Telegram and join the Telegram group. Remember, it's not a signal group. It's just a discussion on fundamentals and the idea trades that we have, and also update on the trades that we have. But for the FOMC session, this is the trade that we took. A 1:2 trade, a very clean, I should say a very, very clean trade. Took it from a 3 minutes time frame. A very good clean trade that I took, yeah. So thank you so much, guys. I know I rant a lot. I'm always talking, talking, talking. So anyway, thank you so much, guys. I truly appreciate all of you. This was another day of FOMC. That gives us a bit of signals as to are we still going off risk or on risk asset, and the conclusion we are on risk now. But let's see what happens in the market. We need to align technical and fundamentals. And remember, in my language, there's a saying which says, hambi swo teka nkarhi, mara swo swi ta lungha. A swi nge endleki, swi nga endleki, which directly translation is, even if it takes time, eventually we'll get there. It's impossible for it not to happen. It's not, hey, a swi nge endleki, swi nga endleki. It's not going to happen that it doesn't happen. Yeah. It's not going to happen that it does not happen. So even though it will take time, uh, oh God, anyway, you get the glimpse, guys, that even though it takes time, it's not going to happen that it's going to happen. Huh? Oh God, I'm going to rant with this for no reason. I hate to fail. Anyway, so it's not gonna it, it's not gonna happen that it doesn't happen. Yeah. Even if it takes time, it's not gonna happen that it does not happen. So this is what I leave you guys with. Even if it takes time, it's not gonna happen that it does not happen. Big ups to my Thonga people, hey? I love you guys. Na Miranda. So anyway, guys, and good luck to Bafana. Come boy, guys, let's go to the World Cup next year. As a lover of football, so I'll say good luck to Bafana, guys. They need to make us proud. Anyway, my rant is done here, guys. I do not stop talking. Anyway, have a great day, guys. Love you all. Have a great